We are so grateful to have you here tonight. My name is Jay Harrison Patterson. I am going to be your moderator. And just to tell you a little bit about me, I started my career as an attorney and found my passion in financial education. And so now I work every day helping people across the country build their financial fitness. So I'm very happy to be moderating for you tonight, but I'm especially happy to introduce the 2016-17 Life Changer of the Year Grand Prize winner, Anna Rubio. Hi, Anna. Thank you for being here.
Hi, how are you? I'm so happy to be here and thank you so much for inviting me.
Oh, we're so
So
happy
happy
to
to
have you.
be able to talk to so many educators out there.
Yes, absolutely. Anna, could you tell us a little bit about what you do as an educator, where you teach, how long you've been in the K through 12 space?
I would love to. I work in Arlington Heights Elementary School, located in Miami, Florida. And excuse me if you hear noise, there's a huge storm going on over here. So that's why I'm just listening to the really hard rain. But anyway, Arlington Heights is located in the city of Miami. I target my audience or my kids are some of our most vulnerable here in Miami. Many of them, unfortunately, have seen a lot of trauma. Many of them are in the foster program, and it's just what I've dedicated myself to. I have a little foundation for them, and that's why I won the national life. I mean, um, what
Change
is it?
the year. Yeah,
Yeah,
yeah. And what do you teach?
I teach physical education, so I get to have so much fun,
Oh,
and
that.
I just have a great passion for them.
Oh, we're so grateful for you. Um, at what point during your career as an educator did you start to place emphasis on managing your personal finances and saving for retirement?
I hit a real low. I would say it has taken me a good 5 years. So between 6, 7 years ago, I hit a real low. I had so much debt, um, a lot of debt that I had to figure out how to fix this because if not, during my retirement, I'm now 58. Retirement is knocking on my door, and I started getting scared. So the pressure, the financial pressure, I just it called me to learn how to become more financially literate or more educated on my finances at home, my personal finances. Yes.
And what did you do to start that path to financial literacy?
Um, I'm going to tell you something a little bit. Some people are not going to like to hear this, but I didn't really have extra money. Imagine I'm a single mom of three on a teacher's salary. So I didn't have that much to be able to put into my 403B. And I did some research. I first looked at my budget. I was putting into the union $80 a month. I never used the union. The one time I had a problem, the union didn't really resolve my problem. And I said, no, I've had enough. I haven't gotten a raise. Union hasn't helped me. I'm going to take those $80. I quit the union and I put it into my 403B. I gave myself a salary increase.
Wow.
And that's what I did. And now that my sons are grown and older, I have not joined the union again, and I'm placing double into I'm, how do you say, I'm playing catch up, and I'm trying to put as much as I can into my 403B because I am older. I'm 58. So I have to make up for lost time.
Yeah. And it sounds like a big part of your journey was just accountability and educating yourself about your finances and how best to manage your debt and to really be your own best advocate. So, coming from that experience, what do you think other educators can learn from your story?
Um, I, a great tool is the one that you spoke about, the Mint app. Mint app really gives you an idea of where you're spending too much on a monthly basis, and that really gave me a key into my success. And then I also researched, like I had huge credit card debt. I researched companies. The one I used was a nonprofit. They actually go and they negotiate with the credit card companies, and then they help you. They'll consolidate your debt, and then you'll pay a monthly, and then you don't even feel it. And I just cut up all my credit cards, and I didn't buy anything on credit until I had all my credit card bills paid off. I still don't have a credit card. I just use my debit card.
So that is amazing. And it's so perfect because that's exactly what we're going to be talking about tonight is managing debt. So, thank you so much for your vulnerability, Anna. It takes a lot of courage to tell your personal story, especially when it comes to finances.
Yeah.
So many of our nation's educators are simply undereducated and underprepared when it comes to retirement planning and financial education. And so,
Can I tell you one thing?
oh, yeah, absolutely.
I have to tell you, my financial planner, he really guided me, and he set me up with different goals. If it wasn't for my financial planner, I wouldn't be in the position I am now. So it's really important for each teacher, to try out, as find a financial planner who's responsible, who really has your self-interest, who will set you up and give you a financial plan, and everything will be fine.
Yep, absolutely. Couldn't have said it better. And that's why we're here tonight. So thank you so much, Anna. We'll see you at the end. You're going to close us out, right?
Yes.
All right, perfect. Thank you so, so much.
Okay.
So tonight, what we have planned for you is the ABCs of financial education for educators. And tonight we're talking all about debt management. We have an amazing presentation planned for you, and without further ado, I'd like to invite our guest expert, Rebecca Jacopelli. Rebecca is a certified financial planner. She's been in finance for 7 years and is the lead financial planner with her firm. Rebecca, thank you so much for being here tonight.
Thank you so much, Jay. I'm very happy to be here.
Again, like I said, we're talking tonight about debt management. So I want to just quickly go through and review where we've been. Last week, if you missed it, we talked about cash flow. You can go to lifechangeroftheyear.com if you missed that, and the recap is there right for you. Tonight, debt management and student loan forgiveness. Next Thursday, our title is The Countdown to Retirement Starts Now. And then Thursday, November 5th, we'll be looking beyond Social Security for retirement income planning. And we're going to close out this series with a very special presentation, Retirement Planning Strategies specifically for women. So very excited about that. We want to start tonight with a poll question. As we're talking about debt, we want to start. How much credit card debt do you carry? 5 to no debt, 0 to 5,000, 5 to 10,000, or over 10,000. Becky, what's been your experience with clients in debt?
Yeah, so like Anna expressed, it's very stressful being in debt. It can really be a heavy burden that you have to carry. So we want to avoid that as much as possible. But what's interesting to note is that 1 in 10 adults say they carry a credit card balance of over $5,000. Wow. And if you paid a minimum balance of $150 on a $5,000 balance with a 20% interest rate, which is very common for credit cards these days, you wouldn't pay off this debt for over 18 years. And you would have paid $10,000 after all is said and done. So we really want to do as much as possible right now to get ourselves out of debt.
And it looks like our audience is just looking at the poll results is very evenly split. We have about 50% have no debt, 25% have less than 5,000, but then another 25% have over 10,000. So we're all at various levels of debt. And everybody wants out. So, everyone's here tonight to find out, how do I get out of debt?
Yeah, so the first step in getting out of debt is stop accruing new debt. It sounds really basic, but if you can't pay cash, don't buy it. We really need to get in the habit of spending less than we make.
Yes, absolutely. But, it seems really obvious, but it's really hard to a lot of people.
Yeah, it is very difficult. It's much easier said than done. but sticking to our budget can really help us to stop accruing the debt. We need to realize the difference between wants and needs. So if we see that brand name pair of shoes that costs a lot more money, and then we have the regular brand pair of shoes, if the fancy pair of shoes is going to put us into debt, we need to say no to those things and stick within our budget.
How do you determine what qualifies for as a want versus a need?
Yeah, so you can utilize the 50-30-20 rule to build your budget. So that would be 50% goes to your needs, things like housing, transportation, insurance. 30% goes towards your wants. That would be those fancy pair of shoes, those cocktails with friends, new throw pillows for the couch. And then 20% goes towards your financial future. So that would be things like we're talking about today, paying down your debt, as well as saving for your retirement.
All right. So the basic premise is if I don't have the cash for it, I don't buy it. Right. So got it. Let's say that I'm in the position that I have like 6 credit cards, I have a car note, I have my mortgage. Where do I start in trying to get out from under that debt?
So the first thing we want to do is make a list of our debts. This can help us gain a better perspective and also stay really organized. So we want to keep track of who we owe, how much, and at what rate.
And how do you track that? Are you using like an Excel spreadsheet or?
Yeah, you can use Excel, you can use Google Sheets, notes in your phone, anything that helps you to stay organized. And all that information can be found in your statement, so you can easily access it online. And what we want to do from there is sort by the highest interest rate or by the highest amount of debt owed, and we'll go over that later.
So I've created my spreadsheet. I have all my debts listed. What's my next step?
So now we want to make payments on time. I can't emphasize enough how important this is. So when it comes to the benefits, they would be avoiding late fees. That's just going to add to the cost that you have of your debt. It can also increase your interest rate if you don't make your payments on time, which can snowball you even further. We want to avoid that. And then it also helps us to avoid a negative impact on our credit score.
So, I mean, it would be nice and convenient if all of our bills were due on the same day every night, but that's just every month, but that's just not reality. How do you keep track of what's being paid when it's due?
Sure. So yeah, that's not the case. It would be nice, but we can keep a calendar of our bills due, and we could also set up automatic payments so that it automatically comes out no matter what we do. And also things like Anna mentioned, mint.com, it has a calendar of your bills due, so that can help you keep track as well.
And Mint and your calendar, they're going to give you reminders when those payments are set to come out.
Yeah, so what is really important is ensuring that there's enough money in the account prior to the due date so that those payments are made and nothing is bounced. So setting up those reminders as well can help us to make those automatic payments and make them on time and properly.
Every time I talk to someone about getting out from under debt, the first goal seems to be they want to pay off their house. What do you think about that?
Yeah, so that's really common. But there's 2 kinds of debt. There's good debt and there's bad debt. And the good debt would include things like your mortgage, your student loans, and some auto loans. It depends on what the interest rate is. If it's a low interest rate, yes. And for these, we don't actually want to pay extra towards these debts. And the reason for that is because these extra funds are better used to save for retirement. You're making more money by investing that money in your retirement and keeping that debt than you would be by paying it off.
So what would be considered bad debt?
So bad debt is any outstanding credit card balances, personal loans, if you have a really high interest rate on your auto loan. And these we actually do want to pay extra towards because we want to reduce that interest burden as much as possible.
Some financial gurus have recommended a very specific debt payment strategy, but it doesn't seem, when I'm talking to people, it doesn't seem to really work for everyone. What do you think about that?
Yeah, so it's not a one size fits all, but here are 2 payment strategies that we can utilize. So there's the debt avalanche and the debt snowball. Now, the debt avalanche is where you pay off your highest interest rate debt first. What this does is saves the most money in the long term, so it's the most economical, but it's not for everyone because you're chipping away at maybe a higher balance and it doesn't feel as satisfying. That's where debt snowball comes in. So that's where you pay off the smallest debt first. And really what that does is helps maintain motivation. So it really, you can knock things off your list and keep the motivation running.
Can you walk us through an example?
Yeah, so here we have a person with two debts. One is $15,000 balance with a 20% interest rate, and the other is a $10,000 balance with a 10% interest rate. So say we paid it off via the debt avalanche route. We would be paying a total of $29,978, and we would have paid that off in 2 years and 6 months. Now, with the debt snowball, we would have paid a total of $31,366, and we wouldn't have paid that off in 2 years and 6 months. Instead, it would be 2 years and 8 months. So a little bit longer and a little bit more money. But as you can see, it's not too drastic of a difference where we would want to say one is better than the other. Really, it's whatever is going to keep you motivated and keep you paying off that debt. That's the route we want to take.
When we're talking about debt, there's often a correlation with debt and credit score. So I think this is a good time to do another poll question. I want to ask the audience, what is your credit score? Is it below 670, 670 to 740, 741 to 850, or do you not know your credit score? Becky, how important is it to know your credit score?
It's absolutely important. I would definitely recommend getting a free credit report from accessing online. Even like I always talk about, mint.com has a free credit score available to you. And it's really important when you're making financial decisions like getting a new house, getting a new car, even refinancing like we're going to talk about soon. Knowing your credit score can help you make some informed financial decisions.
And there you have it. Looks like all of our responses are in. About most of our audience is in that 670 to 740 range. Becky, can you talk to us a little bit about how credit scores are determined?
Yeah, so it's really important to improve your credit score. It's important to know your credit score. So for all of those who don't know it, I encourage you to find it out online. But here's a pie chart of actually how your credit score is determined. And the three major aspects of a credit score are, like I mentioned before, making payments on time. So payment history is actually 35%. It's the largest piece of the puzzle. And when you make a late payment, it can actually stay on your credit report for 7 years. So that's really important to take care of.
Wow.
Also, we have 30% for amounts owed. So this is based on our credit utilization. And what that means is that say I have a $5,000 credit limit and I use $4,500 of that limit, I'm using a lot of that credit. That doesn't look good on your credit report. So getting that down as much as possible will help improve your score. Also, when it comes to the length of credit history, we, like Anna said, she chopped up all her cards. That's exactly what I would recommend. Don't close the accounts, even if they have a $0 balance, because having that length of credit history on your old credit cards can be of benefit to you.
So the most important factor is the payment history, and then keeping it underneath a certain credit utilization. Aside from buying more stuff, what's the benefit of a higher credit score?
Well, a higher credit score can allow you to get a lower interest rate and reconsolidate your debt so that you can get a lower payment. And that's really what we want to do if we have a lot of high interest debt. So the benefits of that are, like I said, we get a lower interest rate. That puts us into one payment, and that can increase our credit score because we're more apt to make one payment than if we have like 6 different credit cards all scattered around.
Yeah.
And the various methods for debt consolidation are, one is a balance transfer. This one is the most beneficial because there's oftentimes a 0% introductory rate as long as you pay it off within a period of time. Sometimes it's 18 months, but you want to make sure you can pay it off in that time frame. Then there's a home equity loan. So you can use the equity in your home to take out money, pay off all your high interest credit card debt, and then have one payment with this home equity loan. That'll also be a lower interest rate than your credit cards will be. And then there's a personal loan. This will do the same thing. This will get everything into one payment, but it's not going to be as attractive of an interest rate as a home equity loan.
Right. So right now, I hear a lot of people talking about wanting to refinance. What do you think is the benefit to that?
Well, it's a really great time to refinance. So interest rates are at historic lows. So I'd recommend doing so if your credit score is good and you can get a lower interest rate. Go ahead and do that because what it's going to do is going to lower your payment.
I do know of instances where someone who's refinanced maybe multiple times and then they end up forever owing on their home. How can we avoid that?
Yeah, so you have the option to pick the term when you refinance. Oftentimes it's like 10, 20, 15, 30 years. So oftentimes people refinance and start another 30 years. That's the scenario you're talking about where people are constantly paying the debt. But if the budget is tight, it can be beneficial to do so that you can utilize those extra funds towards retirement. On the other hand, if you want to make sure that your term of payment is as low as possible, then you can just pick a 10 or 15 or 20-year repayment schedule.
Right now, the whole country, where a lot of people are just really suffering right now. And there's someone sitting out there that's thinking, you know what? I've listened to everything about cash flow. I hear everything about trying to pay down debt, but I don't have it. I'm really drowning right now. I'm not going to be able to do it. What would you say to that person?
Yeah, well, sometimes, unfortunately, we just have to make some tough decisions. Sometimes we've made some maybe poor decisions in the past. We bought a house that we couldn't afford, or we bought a car that was too high in our budget. So, what we might need to do is actually downsize. And the financial freedom that that can give you is absolutely priceless. So, even though it may be difficult at first and a tough decision, if you're sentimental with the things that you have, it can really make a huge difference in your retirement and your overall financial future.
Yeah, I mean, that would be a tough decision. But if we're looking back at that 50, 30, 20 rule and how you should spend your money, it could be helpful in just correcting past mistakes where you've overspent.
Yeah, you can prioritize based on the wants and the needs and figure out, if you have a BMW and you can only afford a Toyota, well, let's make sure we align our budget with those goals because that'll allow us to, like I said, contribute to your retirement. So that BMW is not going to feel very good if we can't retire on time. So we want to make sure we prioritize our retirement goals so that we can have success.
When you're deciding between saving for retirement and paying off debt, how do you make that determination?
Sure. So we want to balance debt repayment and savings. The first thing we want to do is actually save for an emergency fund. This is of utmost importance. We know the environment that we're in now. Things are unexpected that happen to us, and this may incur a cost. Say we had a medical issue, we had to pay a copay, our car broke down, and we needed to pay for that. These are things where the emergency fund comes in handy. And what that does is that it means we don't have to go into further debt to be able to fund something. So it's really important to have an emergency fund or a rainy day fund set up for those unexpected events. And then we want to consolidate our high interest debt. So we want to get our interest rate to as low as we possibly can. And once we've done that, then it makes a lot of sense to save for retirement. So that's where keeping that good debt, contributing to retirement, and getting rid of that bad debt comes into play.
Yeah, and we have a special treat for you all. We have an investment advisor who's going to come on in just a few minutes to talk to you a little bit more about saving for retirement. But I know this is an audience of educators. A lot maybe have advanced degrees, maybe have gotten into student loan debt to further their career. Let's do a quick poll question about student loans. How much student loan debt do you carry? Are you loan free? Do you have 0 to 10,000, 10 to 50,000, 50 to 100,000, or 100 or above? Becky, what do you say with a client facing a 5 or 6 figure student loan bill?
Yeah, that can be a heavy burden to carry. But like I had mentioned before, that actually falls into the category of good debt because it often comes with a lower interest rate. So even though you may have that heavy burden of a student loan debt that's large, you still want to make sure that you're contributing to retirement and prioritizing that while also paying down your student loans.
Yeah. And from looking at our results, it looks as if, let's see, most of our audience is debt free, but we do have about 29% that carry 10 to 50,000, and then there's still a portion that has over 6 figures in credit card debt. What options do educators have with regards to debt?
Yeah, when it comes to your student loan debt, there's actually this wonderful program that the government has offered to you. It's called the Public Service Loan Forgiveness Program. And what this means is that borrowers who work for who work full-time in a public service industry can actually have the balance of their loans forgiven. So all you have to do is work for a nonprofit. You have to make payments according to what's most commonly an income-driven repayment plan. That's a payment plan that's based on the income you make, and it'll often lower your payment. You need to make 120 on-time payments. So that's 10 years of payments on that plan while you're working for the nonprofit. And then at the end of that 10 years, the balance of your loan is going to be forgiven. And what's great is that there's no limit on the forgiveness, and the forgiveness is tax-free. But this is often a complex application. So many borrowers often make mistakes. Sometimes they enroll incorrectly, and that can really delay the process. You might need to appeal, and it comes with its own complexities. So there are organizations out there, there's firms out there that will do the application for you. So I highly recommend that, because it's kind of like somebody doing your tax return versus you doing yourself. You don't necessarily have all the answers, and you want to make sure it's done right. And when it comes to your student loan debt, we want to make sure it's done right. So I would recommend utilizing one of those firms.
Wonderful. Becky, thank you so much. This has all been such great information. We really appreciate it. And at this time, I would like to introduce Sean McGill. Sean is an investment advisor, and Sean's going to talk to us a little bit more about retirement planning and how, as we're paying down our debt, we can start saving more for our retirement. Sean, are you there?
I am here.
Hi, how are you?
I'm doing wonderful. How are you?
Great. Thank you for joining us tonight. Sean, could you tell us a little bit about your background as an investment advisor?
Sure. So I have been working in this field for close to 30 years, and my career has been spent working with educators, primarily higher education. But over the last decade, we have been working very closely with the K through 12, and commonly maybe referred to as K through 14 with community colleges.
Wonderful. Thank you. Now, we heard Becky talk a little bit earlier about basically the steps in debt management, getting your debt out of control, start saving for an emergency fund, and then really start saving for retirement. When in that process and your experience is the best time to get an investment advisor on board?
Well, I think that working with a certified financial planner like Becky is something that somebody should do right out of the gate. Some planners are also investment advisors, some aren't. But I think working with somebody to make sure that you have your house in order, and then when you start getting that emergency fund put in place, and you want to start actually investing, and maybe when you have $5,000 to $6,000 to $7,000 or $8,000 in your 403b, then that's the time maybe to reach out and work with a professional who can help you with those actual investments to measure your risk.
Right. Awesome. That's amazing. Thank you so much, Sean. And audience, I want you to, at this time, any questions that you have, whether it be about debt or retirement planning, working with an investor, the chat box is open. Type your questions right there in the chat box, and we will start answering those questions right here live. This is the best part of the presentation. And we do have a few questions that have already come in. Becky, this is one that we talked a little bit about earlier. Should I pay off my house or my car first?
I would say neither, actually. So those would be classified as usually good debt because they have low interest rates. So if you have extra funds, don't use that to pay that off. Use that to pay yourself and build up your retirement.
Okay. And here's another good question. How many credit cards do you recommend for good credit?
It's actually not about how many credit cards you have. It's really about what types of credit you have. So say you have a mortgage, you have a student loan, you have an auto loan, all of that variety is what looks good on your credit report. It's not about how many credit cards you have. So I wouldn't really focus on that as much as I would on just having multiple types of credit open.
Oh, wonderful. Okay, thank you. Is it really beneficial to refi my mortgage if it extends my payment time?
It can be. So if you're utilizing those funds, those extra funds that are in your budget to either pay down debt or to build up your retirement, that can be really beneficial to you. So I would recommend doing so if it frees up some money so you can save for retirement.
Good deal. Here's a question. I tried to apply for loan forgiveness. However, the process is complex. Do you have any suggestions on who to contact to help with the application?
Yeah, so I know an organization personally called Student Loan Tech, and they can certainly help you. They'll see if you're qualified first, and then we'll go ahead with the process of helping you apply. So I definitely would recommend them as a provider.
Yeah, working with the student loan forgiveness is kind of like working with an accountant to do your taxes. You can do it by yourself, but it's a very complicated process and you don't want to get rejected. So it is a good idea to seek a professional for that. Okay, and here we go. We have another question. Do you recommend rolling my credit card debt into my mortgage?
So you can't really roll your credit card debt into your mortgage. That would more be like the home equity loan that I mentioned before. So you're tapping into the equity in your house to take out a loan and utilizing that loan to pay off your credit card balance. And that is definitely a great way to consolidate your debt, get a lower interest rate, have a lower payment, and that way you can utilize those funds for other things.
Wonderful. Well, that is all the questions that I have popped up thus far. We thank you all for your amazing questions. And Becky, thank you for being here. Sean, thank you for being
You're
here.
welcome.
We absolutely appreciate all of your insight and all your knowledge. And at this time, we want to remind you, if you haven't yet registered for the entire series, next week, Thursday, we'll be doing the Countdown to Retirement, and that starts right now. The Thursday following that, November 5th, we'll be looking beyond Social Security for retirement income planning. And then our finale on Tuesday, November 10th, is retirement planning strategies for women. That's a very special presentation. You don't want to miss that. Again, if you want to connect with a financial professional in your district, you can visit the link in the chat box, lifechangeroftheyear.com/FF contact. If you just want to dig a little bit more into financial education, you can visit the Retirement Homeroom, which is another resource that has a lot of really good information on financial education and financial literacy and just getting your financial house in order. Again, thank you so much for joining us tonight. We really appreciate you being here. I'm Jay Harrison Patterson, and on behalf of our entire financial professional team, I'd like to turn it right back over to Anna Rubio, who's going to close us out for the night. Anna?
Thank you, Jay.
Thank you, Sean.
Yes, I learned so much tonight. I had no idea there was a difference between good debt and bad debt. I had no idea. And also, I want you to know that I'm also in the student forgiveness program. And you just need to reach out to a reputable organization, like Rebecca had said, and get it. They'll walk you through it all, and it really does work. So thank you for everything. It was such a pleasure seeing everyone. Teachers, please stay safe. Please wear your mask. So happy that we're here together, learning a lot about our personal finance. Thank you.